Hello, and welcome to another podcast, Wealth Transparency. Today we have Michelle Connell with Portia Capital out of Fort Worth. We have Lex Nikpour with Ethos Wealth Management or Ethos Financial Group, out of King of Prussia, Pennsylvania, and Andrew Tang with Turner Financial Group. For those of you who are consistent listeners, we appreciate you very much. We'd love for you to share this recording with others. We do believe with Wealth Transparency, we bring state-of-the-art thinking. When I say that, what I mean is that we're right on the cusp and cutting edge of every subject that's going on. Wealth Transparency was created to talk about subjects that don't necessarily make the big headlines. Although right now, it's hard to talk about anything other than oil prices and the Middle East. So Andrew, why don't you kick us off and give us your view on oil prices, when they're going to change, because we had President Trump last night give a speech and it did not go over very well with the oil prices.
Not at all. His speech actually was worse than expected, in my view. It's really more of the same. But regarding oil, we're seeing a little bit more volatility as the Strait of Hormuz, is it going to open or reopen? But the good news is that 2 days ago, UAE had pledged that will join the US to basically help in the effort to reopen the straits. So that's good in the long term. In our study, we also predicted that the straits will reopen and there will be a resolution coming soon. And that's also looking pretty good. But you see oil for the May futures pop up to 108. Oil per barrel, it's already at 100. And gasoline prices, it's over $4 right now for the national average. That's what we're seeing right now, and the pressure is on. But most people in the United States, it's still thinking with confidence that the oil prices is still going to be transitory and short-lived for this kind of spike.
Yeah, that's the way that I feel about it. I do not believe the events in the Middle East are a major economic event. I believe that they're a short-term event when it comes to oil. But Lex, when we talk about oil, the countries that are getting oil from the Middle East, it's not the United States, it's the European countries and the Asian countries. Why is it, and I'm asking you to put on your geopolitical military hat now, but why is it that you believe that these countries are not getting in there to back the U.S. in their effort to open up the Strait of Hormuz?
Exactly where I started at, because I think dependency would be the headline, right? Dependency in so many ways, not just from an energy perspective, but across all the byproducts from oil, but then not to mention the agricultural needs of these countries and so on and so forth. So I think to go in and necessarily tether themselves to the United States when there's so much dependency across the slate of commodities for a lot of these other countries, it doesn't leave them many options to hedge their national security risks and on a go-forward basis for the industries that support those relative sovereignties. So it's a I happen to disagree with you, Ed, just on the basis of this thing being short-lived. I don't believe that to be the case, and I believe a lot of what's occurred already is some damage that is going to take years to be able to right size. Luckily, to your point, the U.S. is in a unique position from an energy perspective. That being said, there's still quite a bit that we transact with other countries that do rely on those resources. So I think the shocks will be reversed.
It's interesting because when you think about all the players involved in the Strait of Hormuz, you have China, which is obviously a huge power in the world. Then you have Japan, both of them needing oil from the Middle East. And you even have Russia being impacted because of the price of oil. Michelle, which countries do you think have the biggest negative, kind of negatives could hurt them from what's going on in the Strait of Hormuz?
I think it's Asia, because I think it's 80% of the LNG that goes through the strait supplies Asia. And so it's really important to countries, especially those that are making semiconductors in their fabrication facilities. I know that you also have heating oil and cooking oil issues with a lot of the smaller countries in Asia. I read yesterday that the LNG shortages are causing robberies and a few killings as well because they just don't have options that we're fortunate enough to have.
Yeah. And one of the byproducts of this oil problem is inflation. Andrew, why don't you dive into the inflationary impact in the United States, because we're already starting to see it in the European Central Bank or European zone.
Yeah, we're definitely seeing inflation pop up, but the good news is that according to Trueflation, this is one of the engines that I look at, has come down from 1.7 roughly at 1.26 right now. And so if we can agree that the current CPI collection system is still full of lagging data, then we can also address that the inflation issue on the longer term basis is still under control and is still coming down from a long-term trend basis. If we look at the 5-year and the 10-year, we also see that they're very tamed. Also, the Fed chairman recently spoke at Harvard University, and he compared the inflation scenarios in 3 different cases. So he stated that basically, if we can read between the lines, that COVID caused inflation is much more longer duration versus even tariff cost inflation is more of a one-time event. And then also for this particular oil spike scenario from the war of Iran, he maintained that staying put and not raising interest rate is the right move, because by the time the effect comes in, oil prices likely it's going to come down already. And so with that said, we still believe that the long-term inflation is still in check. Overall, I still have to repeat the same thing, is that when we're going through a tech and innovation boom, it's deflationary. So that is the most powerful undercurrent deflationary pressure that's working behind the scenes. And these short-term events, again, it's not slowing down consumption. People are still buying with $4 gas, and even with oil at $100 per barrel. We are a net exporter, but still there's incoming and outgoing that makes it a net exporter, but still we're still dependent on importing oil as well as we're exporting. LNG is doing well, but then we can't really ship it overseas as much as we wanted to. So yeah, inflation will be a little bit higher, but not for too long in my view.
So Lex, Andrew kind of contradicts what you said about this being longer lived versus shorter lived. And the Fed chair, or the Fed chair or the Fed president spoke at Harvard. I can't remember who that was, Andrew, and saying that
Yeah, it was Jerome Powell.
It was Jerome Powell saying that he thought it was going to be short lived. Do you think the European Central Bank is taking measures that will be basically deflationary, or raising rates? Do you think that that's the path they're going to choose?
I think I think from a conflict perspective, it's still too early to tell. Europe is going to be far more impacted than the United States is. So I don't disagree with Andrew. If in fact this conflict does end up, as the president's been saying for the last month, in 2-3 weeks. So that seems to be his constant line: 2-3 weeks, 2-3 weeks. Yet all of last night was rather contradictory to that. So I think it's very difficult to sit here and lay a stake on what the expectations are moving forward, because until there seems to be a real end to the conflict, just the variables and the factors really they vary from one side to the other. I don't think it's fair to say one way or the other. I think Europe, more than the United States, is going to be seesaw effect more than just it's too early to kind of sit here with a crystal ball, which I know is not what listeners want to hear. They want something actionable, and they want something to be able to invest on. However, in moments like this, it's important to A, remember what your strategy is, and B, I think it's also important to remember that your strategy does need to include some sense of flexibility in moments like this, and no action sometimes can be the right course of action to then be able to not throw good money at that situation. I feel good plenty of calls and made plenty of calls right now from clients okay, is this a good time to invest? We're down, we're trading at discounts, and we have seen inflows into the market. But I think this is this is sort of a catching falling scenario where I'd rather see some turnaround. Sorry to divert from your question a little bit, but I think it's all in concert here. Rather see some bottoming and then flip back up to be able to reinvest in, and you'll see some of that.
I think that's an excellent point you make. And Michelle, which countries do you think are going to be impacted the most from what's going on in the Strait of Hormuz? You had said Asian countries, but now we're talking about inflationary pressures, and I think they go hand in hand.
Well, if you have fuel that you're cut off from, that's really going to impact your cost of living. Definitely, you're going to see Asia being impacted. I also read that Australia, which I didn't realize is hugely impacted because they depend upon that fuel as well. And they've already had 500 to 600 gasoline stations where you have to queue up. It's restricted. So a lot of that part of the world is trying to pivot to make do with what they have. And in some cases, their countries are even releasing what little reserves they have to keep the pressure down on prices. So we don't have that issue here. So we have to be careful about investing in parts of the world that are going to have a longer impact. I also thought it was interesting that Christine Lagarde said that she will not be paralyzed by inaction. So I think they're fine if they keep interest rates high in order to keep their inflation rate low. So she's willing to be more punitive to the EU. Then fortunately, we don't have that issue with our Federal Reserve. They're a little bit more softer in their approach.
Yeah, and the Fed held rates steady at 3.5 to 3.75 and said that no cuts until inflation clearly drops. And that goes back to what Lex had said, is that you just don't know which way things are going to go, so you're probably better off not doing anything. But that does bring us to the labor markets, Andrew, something I know that you like to talk about quite a bit. And the hiring has slowed and job losses have picked up. What do you think is the reason for that?
Yeah, it's the continuation of the expansion in automation, software, hardware included, and obviously, the word AI. Right now, Fortune 100 companies, 500 companies, if you're not using AI, that something is wrong with the company. The teams are getting smaller and smaller, and we have directors in each department that I've talked to, boots on the ground, with people with, that run departments. They have the AI agents. They're testing them out. They're hiring business consultants to teach them how to use AI. And almost each department are basically cutting staff. And they are also, once you see people, they're old school, they're older, and they have multiple screens because they're running AI agents on the other screen. So they're doing this testing and real application. And we're also seeing the efficiency improving quite a bit. So this firing or this labor market reshuffling, it's going to continue for a while. It's going to continue. And even though we see, unemployment and hiring and the jobless claims bounce up and down, it's still going to be a downward trend there. New jobs are still opening with AI, robotics, and these, tech-related fields. But again, this reshuffle is happening faster than people can switch their careers. Well, constructions and blue-collar work, those jobs are also available too, and they're not filled fast enough. So that really goes to show that this whole hiring is really changing the way we think about higher education too, because now the college grad jobs are not being filled as plentiful as promised. MBAs are not finding jobs, PhDs are not finding jobs, and then for the beginning associates, they're looking for 3 years experience. So there are a lot of college grad, they're under pressure right now, and also existing workforce, that could face, job cuts are also not feeling good. And that's why the consumer sentiment is always down.
So Torsten Slok, the chief economist at Apollo, put out a memo today saying that in recent years, employment in the software sector has declined by about 200,000 jobs. The factors driving the decline could include AI, Fed hikes, or immigration restrictions. Either way, the 200,000 decline in software employment should be compared with the 63 million people who find a new job each year, the 38 million who voluntarily quit their jobs, and the 21 million who were laid off. And I found that note to be really timely for this conversation, in that he's saying basically we have 63 million people looking for new jobs every year. And so far this year, we've lost 200,000 to possibly AI. I'm sure that you read that memo because it was put out by your firm today. What are your thoughts about why the job losses and slow hiring?
Yeah, I did. I tend to follow Torsten. I've been following him for years. I think he does a nice job of A, staying pretty apolitical, and B, just, explaining the facts. But Andrew hit it. I believe that the AI adoption is certainly causing these business owners and CEOs and managers to look at their operations and see how can we be more productive and increase our margins while decreasing our costs. And costs, as we know, for business owners by way of personnel, particularly underperforming personnel, is a significant one. So, but I think a tone of optimism should be found in that, where really you're finding productivity. So there will be productivity gains, and I think that's important. And while it might be dismal for those graduating from school, there's also opportunity, because those individuals can now start businesses through the use of and the leverage of AI that perhaps they might not have been able to before, for far less of a cost than they would have been able to before, rather than going to take a rank and file early position at Microsoft. Not to say that there's absolutely anything wrong with that, but that might have been just the go-to. Hey, I'm going to go to a stalwart corporate entity, learn something, and try to make my way through the ranks, where now they have the inspiration perhaps to go start a new company that then gets acquired by a Microsoft or rivals a Microsoft. And so I think that there's productivity gains to be had here. We are going to go through this difficult time where it does look like there's going to be folks looking for new jobs and there's going to be layoffs. But I think it needs to be really looked at relative to the opportunity as well. I was at a conference last week, and the CEO of a company was talking about how they're using AI and how they've integrated it over the last, call it 18 months or so, and how they've been really allowing their workforce to take a step back and say, we're all learning here, and say, we're giving you the opportunity to take on this new role of adding agentic AI into your work model. And then they're grading everyone on that, on their ability to scale that learning into their process. So what's unique about that is you're going to get folks who are early adopters, and they're starting to use it day in and day out, just like Andrew said, where they've got their other screen that's using this model while they're working. You're going to have folks that just can't seem to get there, and that's okay. There will be a place for them. It's just it might be somewhere lesser than they were before. And I think that that's all really a sign of, hey, we're in this revolution 0.0 or whatever you want to call it, where we're going to go through some difficulty, but at the end of this, and I think moving forward, we're going to realize where the job creation lies. It's just a little bit hard to see through the forest through the trees.
Well, Michelle, small businesses are under pressure because of fuel costs, tariffs, and regulations squeezing margins, which somewhat surprises me, given that I believe that the Republicans are less into regulations and more of relieving regulations. But increased regulations are hurting small businesses. And then you have diesel near $5 a gallon in many areas, and many firms are delaying expansion or shutting down. So what do you say to small business owners at this point?
Hopefully they can hang on, because we're dependent upon them as a country for job creation. I mean, when we read what was it, the last couple days, Oracle let 30,000 people go via email. I mean, there is no safety in those large companies anymore. If I were to give advice to employees or students graduating, It'd be towards the more mid-sized firms or smaller firms where you can probably build out a niche for yourself. It's easier to stand out, but at the same time, those companies their costs are higher. As you said, the diesel's higher. Deregulation's not happening as fast as we had hoped with Trump. You're seeing that in the companies that we thought were going to benefit sooner from that trend. I think it's going to happen, especially if we keep control of the Senate. But we're dependent upon those small businesses, especially now. So we're going to have find a way to make sure that they can hang on despite all the costs. I am seeing in North Texas, the smaller businesses are holding on to less inventory. And when you go in and you want to buy something that's even basic, a lot of times they don't have it. And so they have to order it. I'm talking even things like everyday things that a woman would use, like cosmetics. You're going to a department store and they're like, sorry, we're just not keeping as much anymore, because they don't want to tie up their money in inventory. And that means if you don't have the inventory to sell to a customer, they may not come back.
Yeah.
So that's going to be an issue too. So in that case, I don't come back. I order it online. It's like, why am I going to go into the small business even though I want to support them?
Yeah.
But you're not able to.
Oftentimes I try to calculate the profit margin. I go to Salada and I count the number of people that come in at lunchtime. And I think, my goodness, if they're making $5 a customer and there's 20 customers, that means they made just $100 in that lunchtime. I mean, it's really difficult for small business owners to make it. And the food business is one that you can't replicate from being, online, although you can order in. And I know it's surprising looking at me that I go to Salada, but I do. So let's just get that out of the way. But there's definitely a lot of economic pressures in the world today. And one of them, Andrew, in our final subject has to do with mortgages. The 30-year mortgage went back over 7%. Even though we cut the Fed funds rate, the long rate went higher. Can you explain to everybody how that happens?
Yeah, absolutely. Because this really moves freely, and is more tied to the 10-year yield. And so, whenever there is a risk-off environment, cost of capital, sentiment of cost of capital going up, you're going to see the yield, which especially the 10-year, will move freely. So as of late, the 10-year yield has been, moving up, quite significantly. And that's why we saw, with the risk environment and pressure on, future inflation or intermediate inflation has moved up. So from, let's say, the end of February, the 30-year fix for jumbo mortgage, hit sub 6 just for a day, 5.99, and it popped all the way back up to 662. Now it resides 664 actually. Now it's residing somewhere around 645, and that's if you have really good credit. And then, you're going to add a point or two if your credit is subpar or not the perfect score. Gosh, the price of a home right now, you need a 30-year jumbo. It wasn't the case in the past. It's very challenging in terms of housing affordability. It is a great pressure for the economy and for folks who are looking to start a family. First-time home buyer, again, the age of that has popped up to 40. And that's really very difficult for the country and for young people who are trying to start a family. Altogether, affordability is quite an issue. 30-year jumbo, right now is still receding, but it popped back up to as high as, 6.64.
That's amazing that if the average age for a first-time home buyer is 40 years of age, that's a shocking statistic to me. But I believe you. I don't doubt that.
Actually, one more thing. Going back to small businesses, right? Sorry to interrupt you. Every time I pass a store, especially, I live in New York area, I pass a store, I always say, how many of that widget or whatever they're selling, they have to sell in order to pay rent. Every time I do that challenge, I'm astonished, and I don't know how they do it.
Yeah.
Salad. How many salads you have to sell in order to pay rent? You sell trinkets. How many of those things you have to sell in order to pay rent? And rent keeps going higher and higher. What's it, 7%? Grows to 7% annually. It's insane. Again, sorry for the interruption.
No. You make an excellent point. Lex, you're in the Philadelphia area. Are you feeling small businesses getting hurt, and are you seeing them close up more frequently than they have in the past?
So my father's a tailor and small business owner, multiple locations. For him, it's an interesting intersection where you still a tailor in an affluent area in the western suburbs of Pennsylvania or Philadelphia. So you get sort of the sentiment of the buyers, whether they're buying more, whether they're actually coming into alterations, they can afford to do it or they're not. He's had challenging times, candidly, since COVID. There have been bursts of opportunity, but I think the consumer is feeling squeezed. So I sort of use him as a little bit of my gauge. Now it's not 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 foolproof here, but I was just in Kansas City this weekend and I was amazed at how much of the downtown area and starting to push out that there were storefronts and what looked like great office locations absolutely vacant. Now, there's trend to that as well, but I think they would show that Kansas City has seen some population increase. It's just amazing to me that there are so many vacancies. Now, maybe it's because there's a lot of e-commerce and people aren't in the office as much anymore too. Yeah, I don't know. In my area in Wayne, PA, small business seems to be doing okay. But I think to Andrew's point, it's a matter of time and the cost of doing business as those creep up. No one's immune from that margin. And as far as buying homes, I mean, I just did it last year, so or this past summer, and I can tell you, I was 37 buying a house, and my wife and I, this was our second home that we were looking at, and we were by and large the younger ones looking and bidding on homes, which you go from someone that's then in their mid 40s in their career, what you're earning in your career in your mid 40s to late 40s, the bidding up that happens is unbelievable. It was unique. But I'd also say that this is one of those times where if you need to, and buying a home, I think is important. There are other products other than just your 30-year mortgage, and you have to, as a consumer, I think you need to be smart about how you look at, okay, what's my career trajectory? Where do I anticipate being in 10 years from where I've been? And making decisions that are really personalized to you, not necessarily taking the advice of maybe the parents' generation that was far more risk averse than you are, and recognizing the products, and also recognizing 2008 wasn't all that long ago, and 2005, which led to 2008 and all of the unique real estate transactions that led to that. But just being aware of, listen, if I take a 10 in one arm, so I lock in a rate today and I'm just paying interest only, but I get my bonuses at the end of the year and I can put down to principal and just pay the interest now. I mean, you start to sort of work those together, and that's in having conversations with financial professionals to be able to actually model that out. I think it can ease some of that tension that maybe home buyers have on saying, oh, well, I just can't afford to do it, so I'm not even going to look. It's incumbent upon the consumer to really figure out the best personalized advice for them.
I'll tell you, Lex, you gave me an idea for a great new business, and that is getting these GLPs to tailors, because they can, kind of help people say, hey, look, I could do that. But if you take this will help you lose some weight, and then we can really do some tailoring. So
verticals, right? Get as many verticals of income as you
can. So Michelle, we both live in North Texas, and what are your thoughts on small businesses and the closing up of stores? Because we see here in Dallas, restaurants are changing every 6 months, it seems like.
It's interesting that Lex brought up the tailor, because I know that my tailor is having trouble getting back to where he was business before COVID. And even the dry cleaners that is in a very affluent area near a country club in Fort Worth, they're sending out text messages, which they've never done. We're having a special this week on get your bedding cleaned. I think they're even having issues getting people coming in and having, yes, people are working less in offices. I think small businesses in general are having issues. People are spending less. And I read that if this oil stays or gasoline stays where it is now, the average family will lose $2,000 in purchasing power. So that's a lot. That's not a lot of money to, people in our income category. But, the average family, it's a big $2,000 is a big deal.
Yeah. Well, as we do every week, we end with a stock idea. And Andrew, you cannot say Microsoft again.
I'm not going to, because Microsoft might take a little bit longer to realize. Yeah, it's going to take
But
a little bit longer.
so why don't you give us your stock that you would buy today that is not well known? And
I have a great one for you. You ready for this?
yes.
First of all, this is not investment advice. Check this out. In the low carb keto environment trend that we're going, I'm going to give you one that is full of sugar and carb, Krispy Kreme. It's a turnaround story. DNUT, check out the stock, unfilled gap at what, $8.59? Trading at 3 and change. It's a turnaround story. It's not a top end revenue story, but who knows what can happen.
Lex, what about you?
That might be a new segment since I was last on. I'm slightly unprepared in that, but I will tell you something that, and again, this is not investment advice like Andrew mentioned, but in line with what's going on from the oil commodity perspective, I've been buying the ETF and nuclear for quite some time now. I just think there's a long tail on that. I think an investor can be somewhat this might be a little provocative, dismissive of entry level on price, but I think that's just because of right now in the time and the long tail on the back end of it. And in particular, if we get shocks like this, and like Australia, people are in queue for gas, I think electric vehicles, alternative usage of energy are really going to pick up demand, and different than decades ago where the idea was great, the costs were too high. The costs have come down over the last, however many years, and the feasibility is real. So I like NLR.
Great. And Michelle, what about you?
Being the tech person that I am, this week in some other situations, I talked about NVIDIA. Looks interesting because the forward PE has been cut in half since the end of January, from 40 down to about 20, and that's about in line with the forward PE with the S&P 500. So I think that looks interesting, and several other technology areas also continue to look good. But I've always liked semis, so I think there's some strength there. And tech in the emerging markets will continue to do well. And we've seen some softness in general because of their lack of fuel in Asia, as I spoke to earlier. The ETF EMXC, which I believe is the MSCI without China.
Okay, great. Well, I want to thank everybody for watching. Please share this with your friends and coworkers. And I want to thank Michelle, Lex, and Andrew for once again putting on a great show for us. Thank you.
Thanks, Ed.
Thanks for having me.
Bye.